Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So welcome back to the second video in the Mohnish Movember series that I'm doing on the channel right through the month of November. If you're not familiar and you haven't seen the first video, definitely go check that out. But basically this is a month-long series where I'm attempting to clone the Mohnish moustache. As you can see, I'm making some progress, but we've still got a fair way to go. And basically each week I'm doing a video on an investing lesson that I have learnt from Mohnish himself. So the series is sort of doubling up as a fundraiser for the Movember charity. So I'm also raising money for mental health and suicide prevention. So it's all for a good cause. I'm donating all of the ad revenue from these videos as well. So if you're interested in donating, there will be a link down in the description below. The goal is to raise $1,000 for Movember, and I'm super happy to say that we're already at $520. So we've made an incredible start on the fundraising front towards reaching that $1,000 target, but we've got to keep the momentum going. So if you are interested in donating and helping us work towards the last $480 to reach that target, link down in the description. Any sort of donation you can possibly spare would help a lot, and I would be very, very thankful for that personally. Now in this week's video for Mohnish Movember, I'm going to be giving you some of my top learnings from Mohnish book, The Dhandho Investor. I've read this twice actually. I read it for the first time last year, and I read it again a second time just probably a month or two ago. So it's a fantastic read if you haven't picked it up already. It's available on Amazon, I think is where I got it from, shipped down here all the way to New Zealand. So it's a great book, and I'm going to give you some of my favorite lessons and favorite kind of investment stories from that book in today's video. Now I'm going to leave a timestamp up on the screen here somewhere, and there will be also timestamps on some of the different topics I'm going to talk about today along the bottom of the video, which you should be able to see. So if you want to jump straight forward to my lessons from the Dhandho Investor that I'm going to talk about today, feel free to. Before we do that, some shout outs are definitely in order for some of the people that have donated to the Movember cause. So I just want to spend a couple of minutes giving a personal shout out to each of those people, because I'm very appreciative of everyone that has donated so far, and it's a fantastic cause that this money is going towards. First donation we had is from Neil. Neil actually has a YouTube channel by the name of the Adventurous Investor here on YouTube, so I'll put a screenshot of that up here, and I'll try and put a link in the description as well, so definitely go and check that out. We also have a donation from Jack Duffley. Now I actually did a podcast episode with Jack, so go and check out his YouTube channel as well. He talks about all things real estate investing, so really good resource there. Next we have a massive $200 donation from Hudson's Electrical Limited. I believe this is Shannon Hudson, who has been a long time subscriber to the channel, so really appreciate that, and Space to the Moon, fantastic advice of course. So thank you for that, Hudson's Electrical. Next we have Michael Schmidt. Michael also has a YouTube channel, so go and check that out. I'll leave links to all these channels down in the description below, and put up some screenshots here so you can see that. So thank you to Michael. Next donation we have is from Luis. Now Luis again has been a long time subscriber and actually sent me one of the books back here, Payback Time, signed by Phil Town after going to one of his workshops. So thank you, Luis. Angus, I know Angus personally, and he has also been a fairly early subscriber, so thank you, Angus. Dino, I actually have no idea who Dino is, so Dino, if you're watching this video, thank you very much. I really appreciate it. $100 donation, that's incredible. Next donation is anonymous. We also have one from Charles. I believe Charles is also a long-time subscriber, potentially based in Singapore, I think, so thank you, Charles. A donation from Victoria, who is going to be checking the moustache progress by watching the thumbnails as they come up. We also have a donation from Anna. Thank you, Anna. And the last donation is actually from me. So one of the things I am doing right through Mohnish Movember is donating ad revenue from all the videos. So I'll put up the analytics here. I think it's done like $18 or so far, that first video. So a bit of Swedish rounding, I've pushed that up to 20, and that is all the donations we have got so far. Now the first lesson I have from Mohnish and the Dhandho Investor is this idea that the classic really good entrepreneur actually takes very little risk. And this is kind of counterintuitive and counter to a lot of what you see maybe on social media with entrepreneurs who are sort of have oftentimes this sort of all or nothing mentality, where they're willing to lose a huge percentage of what they have, but they're doing it in order to have this potentially very high reward on the other side if their business venture does go well. So Mohnish Pabrai presents this idea that good entrepreneurs actually take very little risk. He talks a lot about Richard Branson and some of the business deals that he has done. And one of the stories he also presents is about the Patel family in the US. Now, the Patels represent about 1 in 500 Americans, but they have a disproportionately extremely high ownership of motels in the US. Now, as Mohnish wrote this book, which I believe was in around 2007 or 2008, I'll put the exact dates on the screen here somewhere if I can. At that time, the Patels controlled about $40 billion in motel assets, and the way that they got started is really, really interesting, and it was a way where they could set up a situation where they had very, very high reward relative to their starting point, but also very little risk. Now, basically what Papa Patel sort of did when he bought the first motel in the States is he bought a distressed motel that was not doing very well, and he was able to get it at a really cheap price. Now, he did have to borrow some money to do that, but basically he only put about $5,000 down, which was a large percentage of what he had at that time, basically everything he had at that time. But the maths basically worked out that it gave him a place to live and for his family to live. They lived very cheaply on basically no money in this motel. So it provided sort of some shelter for them personally, even if this venture didn't work out. He managed to borrow the rest of the money. I think it was around $50,000 in total to purchase this first motel. And they could operate it so cheaply because he had family basically living there and helping him to run the motel that he could produce about $15,000 a year in cash flow with only a $5,000 initial investment. And this extremely frugal, extremely low-cost model was basically something that the Patels kind of rinsed and repeat year after year after year after year. So when they bought the first motel and it did really well, it was producing very positive cash flows relative to pretty minimal upfront money, they basically took the newly built equity and they brought other family members across to the US and kind of repeated this process over and over again. And other motels just couldn't compete with the Patels on price. And it meant that they had this huge advantage, huge sort of moat that we would call it in stock market investing, that allowed them to continue to grow and grow and grow, and all of this with basically no risk. The amount of capital that they put in up front was very, very minimal, and even if that initial first motel failed, it's likely that they could attempt this all over again if they really needed to. And Mohnish Pabrai took this low-risk entrepreneurship approach into starting his own IT services business in the 90s. If you don't know already, that is how Mohnish Pabrai really got his initial pool of capital before he became an investor, was through this IT services company. And again, he did it in a way where he had fairly minimal risk. I think up front he put in around $50,000, which is a reasonable chunk of money for anyone that's not very, very rich already. But the way Mohnish Pabrai set it up was that he never left his job or anything like that, or put himself in a position where he could go to zero and the business had to work in order for him to still put food on the table and all that sort of thing. He kept his day job, and how he describes his process of keeping that day job and his performance at that job is basically that his goal was to operate in a way that was just above firing level. Previously, he was a really good employee, performing well. He wanted to put in basically a lot less effort than he had in the past in order to prioritize his new side hustle, which was starting this IT services business. And then once that business did get to scale, that's when he then left his job and went kind of all in on that IT services business. But he set it up in a way where he still had his day job. He definitely wasn't performing as well as he had in the past, but he didn't get fired, and he was still having that initial full-time job, pay the bills and all that sort of stuff. And then he eventually grew this side business into his main business, and it made him his first several $1 million in the 1990s. Now, the second lesson from the Dhandho Investor that I want to talk about today is this concept of investing in low-risk, high-uncertainty businesses. Now, I've brought this up a few times on the channel, but I haven't spoken about this specific example that Mohnish Pabrai uses in the Dhandho Investor, which is actually a funeral company called Schmidt Enterprises. Now, basically, general investors in the stock market often view risk and uncertainty as the same thing. Mohnish Pabrai does not. Basically, he defines risk as the percentage percentage chance of a permanent loss of capital. So if there's a high chance that you invest $1,000 in something and you're not going to get $1,000 back out in the future, that's what he views as risk. Now, uncertainty in his mind is not necessarily directly related to risk. Sometimes it is, sometimes it isn't. Uncertainty in Mohnish Prabrai's mind is just simply a wide range of potential outcomes for that business. So what Mohnish Prabrai likes to search for is this combination of low risk and high uncertainty, because markets don't like uncertainty and they typically price businesses where there's a potential wide range of outcomes very, very cheaply. So if you can find a scenario where the outcome range is wide, but in pretty much all of those different outcomes, you're not going to lose money and your risk is very low, there's potential for you to make a lot of money in that setup. So let's talk about Schmidt Enterprises. Now, Schmidt Enterprises is a funeral company, and there were many public funeral companies in the 1990s. There still are many public companies today. Schmidt Enterprises does still exist technically, but it's now not its own separate stock. It's actually part of another funeral business called Service Corp, I think it is. I'll put the exact name on the screen here again so you can see that. But basically what was going on in the 1990s were many funeral companies were basically trying to consolidate the funeral home business. They were going out and searching for these kind of mum and dad funeral homes and basically buying them up at a massive scale. And the way that they were funding these acquisitions was through both cash and debt. They were borrowing a lot of money, really leveraging up the businesses in order to buy these cash producing funeral homes. But what happened next was a lot of these funeral companies basically pushed it too far. They borrowed too much money. They tried to acquire these kind of mum and dad funeral homes and far quicker than what they could handle in terms of their debt servicing, that eventually some of these companies started to head towards bankruptcy, and a company called Lowen actually did go bankrupt. They took on too much debt, and this kind of started this whole chain of events of stock market investors not liking funeral home companies, and the prices just absolutely tanking. So when you look at the business of Schmidt Enterprises, the stock went from $28 a share to $2 a share. So it went down a huge percentage, and this is when Mohnish Prabrai started to get really interested and take a closer look at what was going on at Schmidt Enterprises. Now, what Mohnish Prabrai found after looking into Schmidt Enterprises is that the company had around $930 million in debt, and they had around $500 million coming due in the next couple of years, in about 2002 at that time. But on the surface of things, the business looked very cheap if it could survive those debt repayments. It had a PE of under 3, and this, remember, is in a funeral home business. That's about the most steady business you can have on the planet, just about. It was trading at a PE of less than 3, and it was trading at a book value of about 0.5. And in this case, the book value included basically land. So that book value is real. You can liquidate and sell that land at a reasonable price if you need to. And he even felt that book value was actually understated, because the price that this land was held on the books of Schmidt Enterprises was for the price that Schmidt initially paid many years ago. So in fact, the land was probably worth a lot more, and to see it at 0.5 times book value was an extremely depressed price. So here you have a business in an industry with extremely slow change. It's basically the steadiest business in the world. There's not a lot of new young entrepreneurs wanting to get into the funeral home business. And you have a business with all these characteristics that really suggest that it should not be trading at 3 times earnings. This is an incredibly steady cash producing business that should definitely be trading at a lot more than 3 times earnings, which is really a price that people pay when they expect a business to just terminally decline, basically. So after doing that work, this is how Prabrai viewed the business. And remember that at the time, Schmidt Enterprises was trading at about $2 a share, down from 28. So these are basically the range of outcomes that Prabrai saw for the business. The first thing Schmidt Enterprises could do is they could sell some of the funeral homes. They could liquidate some of them in order to generate enough cash to pay their debts. In that situation, he felt as though Schmidt Enterprises would be worth at the very least $4 a share, assuming they could survive and have a slightly smaller business, but with less debt load and, the ability to survive at least into the future. So that was the first thing. The second thing he thought could happen would be that the lenders looked at the good cash flows that Schmidt Enterprises were generating, and then they would be a bit more lenient and kind of extend out the lifetime of many of the loans that had been initially made to Schmidt. In that situation, Pabrai again felt as though Stuart would be worth at bare minimum about $4 a share if that happened. The third possibility that he thought would be that another lender would come in and again see the good cash flows of Stuart Enterprises and offer them more debt or extend out the loans, basically acquire the debt from the initial lender. Again, he felt that this would produce an intrinsic value of well north of $4 a share, or he thought the worst case scenario is that Stuart Enterprises does go bankrupt. Now, in this case, you have a bankruptcy where there are a lot of assets in the business. Basically, what Pabrai thought would happen is that all of the debt would get paid off from liquidating the funeral homes and even selling them at distressed prices. All that debt would get paid off, and then there'd still probably be about $2 at least per share there to distribute out to existing shareholders. And just as an aside, Pabrai actually did write about one other potential outcome in the book, which is basically a meteor hitting Earth and destroying all the assets, in which case Stuart Enterprises would be worth $0 a share. So here you have all these different outcomes that are possibilities for Stuart Enterprises for this funeral home business, but absolutely none of them result in shareholders ever getting less than about $2 a share. And Stuart at the time is trading for about $2 a share. So you have this huge margin of safety and you have this unique combination of low risk and high uncertainty. So what happened with Stuart Enterprises? Well, basically they went for one of the potential outcomes that Pabrai saw, which was to sell off some of their funeral home assets in order to pay off debt. So they went down that track, they paid off the debt, or at least a good chunk of it. Eventually, over the next really just 1 to 2 years, the stock went to about $8 per share, and Pabrai collected a 4x on that investment in a very, very short space of time. Now, the final lesson I want to share for today from the Dhandho Investor is the story of Arjuna and being singularly focused. Now, this is a story basically about a group of people learning to be good archers and trying to shoot a fish directly through the eye. Now, basically the trainer asks each of these students when they're about to go ahead and attempt to shoot this fish, what do they see when they're lining up their target? And many of the people said that they saw the fish, they saw the water, they saw the eye, and so on. And basically the trainer did not let those people shoot. They didn't tell them what they did wrong. They just said, no, next person. They'd ask the next person what they saw. Again, they'd describe all these different things that they saw. And then eventually along came Arjuna. And Arjuna said, all that I see is the center of the eye of the fish. And then he was allowed to shoot his arrow. It went straight through the eye of the fish. And he was sort of singularly focused on the exact target and the exact point that he needed to hit. So how on earth does this relate to investing? Well, in a couple of ways. Basically, what Pabrai is saying here is to focus singularly on businesses that are in your circle of competence, that you can understand, that you can value, and then focus solely on the facts and the performance of that underlying business. Now, as you'll know if you've been investing in the stock market for any length of time, there is always all of these distractions and all of this noise coming out about the stock market in general, about specific businesses. You see many headlines about how businesses are doing great, and then the next day you see one about how they're doing terribly, and then you see how is the election going to impact stocks and all this kind of stuff. And basically what Pabrai is saying here is that the performance of individual businesses in your portfolio that you understand really well and that you bought at an appropriate price, assuming that you've done all of that really well, that is going to be far more important for your returns than what the broader market is doing. If you've bought Stuart Enterprises at $2 a share and you've got all these potential outcomes and none of them result in you losing money and many of them result in you making a lot of money, then what the broader market does is not important whatsoever. So be singularly focused like Arjuna. That is my final lesson that I thought I'd share today from the Dhandho Investor. So thank you all for watching the video. I do hope it was helpful and you enjoyed. I do also hope you're enjoying the series of Mohnish Movember. I certainly am. And I'm absolutely over the moon with how much money we've raised so far. So if you are interested in contributing, again, the link will be down in the description below. We're trying to reach that $1,000 target. And even if you're not in a position to contribute directly financially, feel free to contribute indirectly. Hit like on this video, share the video, watch it right to the end. You've already done that if you're at this point in the video. And that will help push the video to a wider audience and increase the ad revenue and all that sort of stuff. And that puts me in a position to donate a bunch more money from the ad revenue from these videos. So hope you enjoyed it, but that is all from me today, and I will see you in the next one. Cheers. Mo check.